I think 24 was always going to be a tough year from our perspective, given the election cycle we had and interest rate normalization. So there's no doubt that the windows for an IPO where you really need 2 or 3 months where you expect volatility to be depressed were always going to be quite challenging.
But markets went up. Surely that provided some
cover. Well, I think that was the surprise last year. We went into last year actually with expectations it was going to be pretty tough, and then we've had global equity markets 20% plus up at the end of the year. So the real anomaly was, I agree with you, we had markets up, vol low, but we didn't have these companies coming. I think part of it was, one, there was a bit of a gap on valuation expectations between the buyers and the potential sellers. I think that's normalized with what we saw in secondary markets. And secondly was actually because of some of those challenges that we expected, particularly no doubt the second half of the year with the US election, a lot of those plans had already been deferred to 2025, which is why this year we're much more optimistic because we feel the pipeline's already been filled with deals that could have come in 24. In hindsight, we probably had a better market than we anticipated, but there's no doubt we will now see people preparing to bring those companies public this year.
Gareth, if I was in your business, which I'm clearly not qualified to do, I would say get it done early this year. I would say get it done in the first half of the year, because everything I'm hearing from the bond market is that there is a pool of liquidity available at the moment that may not be there later in the year, that when some of these risks and the volatility pick up. Ergo, I'm going to, that's one point I want to raise with you. In fact, why don't you answer that question?
Look, I think our advice is always, you need to prepare your own equity story and do it at the right time for your company and your strategic objectives. But I fully concur with you. Our advice at the moment is you need to be ready and prepared. You don't know when these market windows are going to be there, and particularly how long they're going to be there for. It does feel things have set up pretty nicely for the first half of this year. So if your own story is ready, absolutely be prepared, be ready, and we should expect this Easter window to be quite busy.
Maybe I'll send my CV then to the HR department at ECM at UBS. No, I'm joking. You really wouldn't want me. Okay, I know you know that. But the other question is we are spending a lot of time now worrying about sovereign debt, long-term prices and yields picking up, whether it's UK, whether it's US, what have you. Is the higher cost of money, despite rate cuts, actually going to transpire to lower IPO prices in 2025, in addition to the fact that you said, of course, the disparity between the buyer's expectations for the price and the seller's expectations, there has been a bit of a gap there as well. So higher cost of money, which we think is coming on despite these rate cuts, is that going to create a problem for the IPO pricing?
Look, I'd look at it in two ways to answer your question. I think one is actually for corporates in general, it's more a question of what's the right balance sheet structure for a listed public company, and that comes down to leverage tolerance. I think particularly on sponsor-owned assets, that's always the debate. You know, does the US or Europe tolerate lower or higher leverage, and where are we in that cycle? Last year, again, was quite surprising, as we went through interest rate rises, we didn't necessarily see more primary equity being raised by companies, because I think CFOs felt actually they could look through the increases in interest rate to see what we're expecting this year, which is rates to actually come down again. So we don't see stress in the system from corporates in terms of their financing requirements, and we still see investors actually reasonably forward-looking around leverage, particularly for growth companies where they can see that leverage burning off as we go forward. So I think it's more a case of, does a potential risk in the bond market translate into more volatility in equity markets? That becomes harder for us to actually execute rather than a direct play into valuations.